Hey everybody, Lemonade's Q3 letter is up. I've read through it. I posted a bunch of analysis on Twitter. I want to walk through that analysis and give even more of my thoughts on this quarter. Awesome quarter. If you look at the after hours, we're at $65 a share right now. Wouldn't be surprised if this goes even higher. Not sure, or it could go lower. Who knows how the market will react? But I think it was an absolutely outstanding quarter. So let's just walk through my Twitter thread, and then I'm going to walk through my model as well and give you more commentary. More commentary than you would even find on there, and trying to get this out quick to you guys. So yeah, it's a really good quarter. 30% top line's growing at 30%. Premium per customer is still growing. Their total customer count 2.8 million. We'll probably reach 3 million in this quarter in Q4 sometime. But yeah, top line is growing ahead of what they were projecting. They guided 1147 million IFP and they hit 1158. So a beat there. Gross profit grew to 80 million. If I look down in my model here, look at gross profit. Yeah, we have 80 million on the quarter, or 79.9, 80 million. Just look at the numbers before that. It's 64 million, 38, 64, 37, 30, 30, 30, 20. Now we're at 80. And, this is going to only keep scaling up as the business now, as the top line grows. But as your loss ratio has improved so much, you have this incredible amount of growth you can get in your gross profit. Hold up here. Try and go back there. Now loss ratios are coming in at 80. It used to be 80, 90%, and that was a significant issue. Now they're at 62% gross loss ratio, and I'm just going to zoom back into normal rate here, and here we go. And 62% and gross loss ratio, 67% trailing 12 months. And if we look at it, just pull this up. I think I have it down in the thread later in the thread, but ex-cat 56% gross loss ratio. So really tremendous quarter for loss ratios. I remember people criticizing Lemonade, going back a few years ago, where they're like, well, it doesn't matter how much growth you have. If it's still just crappy growth, it's meaningless. Essentially saying, hey, if your loss ratio is still too high, it's 90%, then, what's the point of growing? But you really are growing into their book, improving, cutting away the worst customers and only acquiring the best customers and pricing them all correctly. So that's what we're seeing the fruit of right now. Adjusted EBITDA was minus 26 million versus the guide, which was 34 million. So another beat there. And I pointed this out before, I think it was, in the last week, I pointed this out in a tweet saying, that based on the guidance for Q3 and the full year, adjusted EBITDA, is going to be like really good in Q4. And you can see there, it's going to be probably $13 million loss or better. And if I flip to adjusted EBITDA history, I have it further down in this. I have further down. So I'm right here. Adjusted EBITDA, you can see, if we hit 13 million, the bar is going to be only like this long. But we'll look at that a little bit closer when we get to that in the model. But Q4 should have very strong results for adjusted EBITDA. And operating leverage, I did mention you've seen some of the operating expenses, so a little bit of an uptick. It's not too bad, but relative to how fast the top line's growing, 30%, still really remarkable. And some car details here, 76% loss ratio on car. Let me flip back to this. So cars, let's just go car. Loss ratio by car was 92, 83, 88. And and there was concerns about, how fast can you grow a car if you're only growing 88%? But 82%. And I remember even last quarter I was saying, actually for new customers, like you're seeing 82% or you're seeing 88%, but for new car customers, it's probably already below that are coming in the door. The loss ratio of them is probably below 80%. And now the whole book of car customers is 76%. As people renew, they might have been at a rate that was too low, and then they get renewed at a more proper rate, and you tweak your pricing, you adjust that, and you get the better at selecting the right people, and better at avoiding the wrong people, and you have loss ratios that come in line there. And I think that will only get better. And they also mentioned, Pennsylvania, they're going to be coming at, and they said more than half of new car sales come from existing customers. So that's really amazing. And as I mentioned here, they know these customers. The real secret sauce to Lemonade is not just, hey, we can cross-sell, but they have a good relationship with, hey, this person's an excellent pet customer, renters customer, and now we know because of that relationship they have and the data they already have on that person, it's like we know that they can trust, they're going to be probably a very safe driver. I mean, it makes sense. If you know somebody, you know a customer already in any business dynamic you work at, if you know some customer and know that, hey, this is a reputable person, this is a good person, this is a trustworthy person, well, then you can trust them with more things. So Lemonade can essentially know that ahead of time and have that. That's a huge secret sauce that they have on top of already serving that customer well and being a profitable customer in pet, renters, etc. Loss adjustment expense, which is just the amount of the portion of your loss ratio that is going to basically administrating claims, checking if claims are valid. It's at 7%, and it keeps going down. And they say right here, other organizations, even 10 times the book size or more, have a worse loss adjustment expense than this. Maybe around 9% is more of an average, and they're already at 7%. And they are projecting, hey, future, and why can't this go lower? So this was a year they went, it looks like every year roughly, Q3, every year they're hitting about 2% improvement. So does that mean just in 2% from now we're adding, in a year from now, in Q3 2026, we're going to see that, they might have 5% loss adjustment expense or something like that. I mean, eventually there's going to be an ending point. You can't go 2%, forever, but you do kind of wonder, even based on their projection, why can't they get to 5%? Why can't they get to even 3% as the business scales? And you're hyper efficient in handling the claims. And on top of that too, customers are even going to be happier. It's not like you're sacrificing the quality of the customers, you're actually improving it. And this is what we've been pounding the table on with Lemonade for years. This is what Daniel has so well articulated in so many of his presentations. It's we're really seeing that unfold right before our eyes. Excuse me. And and even on a loss adjustment expense per line of business, I added this dash line just to clearly show, hey, cars already below 10%. It's probably, based on this, around 9% just for car, which is in line with legacy incumbents. And this trend line looks like cars only going to get bigger as car scales further. I mean, cars still relatively small in the grand scheme of things and the size of their book of business. So yeah, solid stuff there. Guidance has improved. Let me just glance at that for full year. So we had 1223 now. This was the previous guidance from a quarter ago. So we had 1218 versus 1223. We had 1047 versus 1039. We had 715 revenue versus 732. And we had adjusted EBITDA loss of minus 127 now for the full year versus minus 135, which we had before. So yeah, pretty awesome stuff there, seeing that. 56% gross loss ratio ex-cat, as I mentioned before. Loss is really solid. Loss ratios by product are also improving. Home and renters is improving. Europe is improving. Home and renters 51%. It probably means they've cut out. They had low catastrophic events for the quarter, which meant their home loss ratio would be solid because they just kind of give a homeowner's multi-peril, which includes home and renters. Pet is a B, 69% again, so right in that sort of target range, super consistent. And it's the pet product. Scales. It's growing some 50% plus per year. Pet is, and car is in really in that scalable range, 76%. And Europe had a huge improvement too. It's down to 70%, which is just your all products across Europe. Gross spend $46 million on the quarter. At the start of the year, they said they'd spend around $170 million on growth spend across the the year. Let me just flip to my model for a second and see where we're at. So growth spend right now, we had $38 million Q1, 49, $50 million in Q2, 46 this one. So we've spent $134 million already. If they spend, say, $44 million next quarter, at least what I have written in there right now, you're at $178 million. By the way, if you want to get this latest Lemonade model, you can find it on my Patreon. It's only $5 a month to join, or you can pay for a whole year and get a discount. But I encourage you to join that if you want to go deeper and understand this stuff even more. And okay, where were we here? Now, yeah, Pet grew. I mentioned Pet grew 44 million. Their IFP grew, by 55%. I had a graph down here. I'll just flip to that one. You can see, look at the green bars of how the pet growth story of IFPs. So this is IFP by product line. And I split up, have an estimate for renters and home in my model. And you can see just the green line for pet has really soared and continues to soar. You're starting to see car was slow, stagnant. They pruning some of the bad customers, and now it's just starting to sort of slowly ramp up. Car they want to be careful with. And, but we will see car, I think, hit a similar sort of trajectory line as you're seeing with pet. And we'll see that, I think, in the next soon here. I think this will start to accelerate. I wanted to just touch on that. I'll flip back to here. So I mentioned in my model now, there was, for every dollar spent on growth, they received $2.56 of IFP. This is a very strong result. I have that in my model right here. Growth's under based on that, and that includes customers that are churning away, because every quarter you have a certain amount of customers that are leaving, that are churning. And so including sort of, if you spend, basically what I'm calculating is if you spend $1 on growth spend, on customer acquisition cost, CAC or CAC, or growth spend, it's all the same thing. If you spend that $1, you're going to get $2.56 back. And I had a graph here as well in my thread. You can see where this result comes in at. If you look at all quarters, what they've spent on growth, and then what that ratio came in at, the higher the ratio, the better the number. As you can see, if you spend nothing, then the ratio is super high because a certain amount of customers just join regardless. And so you're spending a little bit, you're spending a few $1 million, and now way over here they're spending $45 million plus, like in Q3 2025. But all of these numbers are consistently, you see 2025 Q1, Q2, Q3 have all been above this trend line. And I predicted that quarters ago because as you roll out car, you're going to get more and more of this cross-selling effect where you're getting premiums coming in the door for free. So that's going to make this ratio look better and better the more premiums that are coming in for free. So this is really solid that we're at this above 2.5. Even if they, Lemonade could be a very profitable company, even if they could get it, 2, or even could creep under 2, they could still become very profitable. But if they can maintain this, maybe car rolls out even better, smoother, more places, and they're spending, $50 million plus per quarter in future quarter years, but they're above that 2.5 to 2 to 3 range. We're doing really well. You're hitting that perfect sort of range where you your efficiency is strong in your marketing, and then you can calculate it. That's one way you can look at that. The other way you can think about that is your LTV to CAC. So and I calculate this too, I'll flip to my model here. I have this equation that calculates based on your premium per customer, your loss ratio, your annual dollar retention, a time value of money, whatever you want to, you could plug in there. You can calculate, I had a 4.6 for this quarter of LTV to CAC. And it also helps that it helps a couple things. Your customer acquisition cost per customer, I had coming in at $166 per customer, so very efficient. Q3, it's actually super efficient. Q3 is often very efficient, very efficient there. But then you plug that into what your LTV, your lifetime value of those customers divided by the ratio you're spending to acquire each customer, you're getting a 4.6 on this quarter. Now, that's kind of just using if the loss ratio can really make that sensitive because it's projecting that same loss ratio out into the future. But so if you do it on a trailing 12-month basis, you're still at a 3.6, healthily over 3, really, really strong. And the Lemonade in there, I think they said in the letter, I'm sure I read that, they said, we maintained a 3-to-1 LTV to CAC even though we're spending more and more and more on marketing spend. So some people question this, some sort of bears question, oh, this can't be true, the LTV to CAC, can't believe that. But, I think you can, because 3 reasons why. Lemonade literally tells us the LTV to CAC. They've been saying that for years. They say it's 3-to-1 or better. You can just calculate it yourself. But this is an estimate, of course. But it is, I think, a very good estimate based on the data and the numbers they give. You can calculate that estimate yourself. And Lemonade themselves would be kind of measuring in the past this number, this 3, and projecting it out into the future based on how profitable they think a certain customer might be. And then there's General Catalyst, their synthetic agents partner. They literally would see detailed cohort numbers of cohort by cohort of people, of customers, and they are investing heavily in the synthetic agents program for Lemonade, which is giving them additional funding to help their growth spend over the last couple of years and going into next year. So they see those cohort, that data really in detail, and they continue to invest heavily, so which they wouldn't do if these LTV to CAC numbers weren't as strong as they are. Okay, I'm just going to jump through more of my graphs now on the model here. Okay, so you can see revenue is starting to grow. We're taking a big jump there. Revenue will grow faster over the next few quarters as their reinsurance tapers down or improves. Actually, I'm going to flip this one to my model and then go this one back to revenue here. So perfect. And LTV to CAC, we talked about that. LTV to CAC history, LTV to CAC. I sort of see on a trailing 12-month basis, projecting out to 2032, your LTV to CAC, could go above 5 as CAR rolls out, and then above 4 is, I think, very possible. Your IFP continues to grow. Total customer history continues to grow. That I talked about this in my X or Twitter thread there, but you see customer growth continues to improve there. Premium per customer is sort of flat, but will keep creeping up as you roll out car more and more. And even as pet, more and more pet customers, they really corner that market. If you go down here, like that pet premium per customer is $782 versus an average of $400. So that's going to be pulling that average up. What's really pulling it down is your renter's insurance is going to be really low, because even with home and renters combined, you're at $250. So renter's going to be less than. I even have an estimate for that if you go down in my model. I have a renter's estimate of 168. So you're adding renters at 168, but your average, and that pulls your keeps your average down. But of course, those customers are great. They're still profitable dollars, and they're still going to cross sell to other customers in the future. Gross loss ratio, you just want to show look at this trend line back to 2018 was really high. We had like a Texas freeze here. We've had some poor quarters, record inflation, people freaking out, thinking insurance isn't worth it. And now we're trending down and we're at 62%. A trailing 12-month basis also, beautiful. Some of these I would still have to update a little bit. This is like an interesting graph. Present value of all customers. So you can kind of think about this as your LTV, or your lifetime value of your customers times by your customer count. Sort of as an average to say, hey, as the book scales and as your LTV scales per customer, because your lifetime value improves as your loss ratio comes down and as your premiums come up, it really can start to soar. So this will really take off in the coming years, but it's just going to go up and to the right, and that's what it is doing, continues to do. Growth spend. So growth spend here. You also interesting because when they had record inflation, like pricing for products was not where it needed to be, and regulators are slow, dragging their feet to change prices. There's cycle time to get, before you can renew a customer back into the newest price. So they really were slow on the growth spend, and they continue to ramp that up. And yeah, we'll only see that and continue more and more. Eventually, I see them spending hundreds of millions of dollars each quarter on growth spend. It's not going to slow down as you spend more and more just to maintain sort of the level of customer churn, but also then to grow that book. But if you're doing it in a profitable way, which I'm seeing they are, then well, that's what you do. You just keep doing it. So this is that ratio again, that marketing chart. I think that marketing chart's the better way to look at this. But this has an estimate excluding cross sell. I've had sometimes too many graphs, but this is the one I'm more consistently looking at. Because excluding cross sell is just an estimate in itself. So just adding an estimate on top of it, which isn't really necessary, but. Here it is, your 2.56 as your growth spend has increased. Blue line, of course, as it was lower, you had less, and as it's increased, it's come down. But you're still, even though you're at a higher rate, you're still getting really solid result there. Adjusted EBITDA. So touched on this before, but you're seeing it's really obvious where this is going. Like you had this minus 65 in 2022 Q3, low point, and they said literally that's going to be the low point. It's going to get better and better, and it has. And so next quarter is going to be, maybe 10 million, and it'll be like a little short bar here, and then we'll start flipping positive next year. If you take that value and then subtract out growth spend, we're hitting positive, 20 million positive on the quarter, and that's the most positive ever, and then that's just going to keep improving. So yeah, pretty exciting stuff there. Skip over some of these. Adjusted EBITDA as a fraction of gross earned premiums. You can see this would be telling us where we're going to become profitable, and you can see in 2025 we're going to start to flip into profitability here. Customer churn, this is not given by management. This was a huge deal a number of years ago. I remember it was like in the 30s, and people kind of realized this, and this was definitely a concern, but they told us, they gave good reasons at the time why customer churn would come down. It did, and it's been steady at 17% over the last couple of years. Annual dollar retention had a slight increase to 85%. It came down a little bit as they non-renewed a lot of home customers, but I think we're going to see this. We'll get this back into the high 80s, maybe even low 90s as car rolls out. But it really depends how quickly they roll out car. This marketing efficiency graph, again, you see where Q3 is coming in at. Really excellent stuff. It's sort of following, you're almost like creating a new trend line, Q1, Q3, Q2, where you're up in this range where, you could probably spend, you project that out for probably 50 50, 60 million and still have a ratio above 2. So super, solid stuff there. Your customer cost to acquire each customer, we sort of showed this, but in the model, but graphically, you're at $166 dollars there. Your operating expenses minus gross spends, they had a little bit. Last quarter had some uniqueness that dropped it a bit. This quarter has pushed it up a little bit. You can actually kind of see there's actually a bit of a trend line forming here, where we go back to, Q3 a year ago was 84.6, and now we're 95. So it is increasing, but again, some of that's baked into my model going out into the future. But it's still relative to the top line. It's growing 30%. I think we'll grow even over 30%. This is really fantastic stuff. This nice, operating leverage chart where the top line's soaring and your total operating expenses, even including growth spend here, is relatively small. Of course, I have P's on an annualized basis. This is on this is quarter by quarter basis. So there's that to consider when you look at this, but still really, really incredible stuff. Let me see. I don't have when they tell us we'll get some more data on number of employees, and we'll see customers per employee and IFP per employee. Let's see here. The IFP per product, and we touched on that. This is continuing to soar. So yeah, really good quarter. What are we at now? Stock price, or again in the mid 60s, looks like. I take this with a grain of salt because sometimes, pre-market will do things that then will get moved around in the actual market. But yeah, super, super exciting quarter. That we're really seeing the thesis play out before our eyes. I really think Lemonade's worth, based on my model, we're worth. You can justify, like, depending on what you put in here, for 2032, what their profits would be. You can easily justify it's worth 120. I think that's, and you can even say, like 120 to 200, I think is like really pretty easy to justify. Even if you should say, even if 20, this should be, depending on what you think it's worth at any given time, 120 to 200, I think is very justifiable. You could even say, this number here, that they're going to have the market so huge, they have so much growth ahead of them that 2032, their earnings per share, they could give 100x multiple of that, and they're worth discount that to today, and they're worth $350 a share. That's not even impossible, because it's potential the market really sees their ability to price risk more accurately and scale. But more conservatively, you can argue, they're worth $120 a share up to $200 a share. I think that's a good argument. And so I think it's a steal, below $120 a share. So, so I'm going to tune into the call now. Thank you so much for watching this video, and I'm going to have a lot more content coming as I dig deeper into these details. But thanks again so much for watching. Remember, it's in the bag.